You've probably had that moment. It's 11 p.m. on a Tuesday, and you're staring at your banking app. You see a number? Maybe it's 5,000. Maybe it's 20,000. On paper, you're fine. You're not broke. But deep in your gut, you feel like you're running a race on a treadmill that someone else is controlling. You look at your co-workers. Let's call one of them Greg. Greg just pulled into the lot with a new BMW X5. He's talking about his kitchen remodel and his upcoming trip to CABO. You do the envy math in your head. You know roughly what he makes because you sit 3 desks away. And the math doesn't work. The truth is, Greg isn't winning. He's performing. And your bank account, it might be the very thing keeping you trapped in the audience of his performance. My name is Zen, and I've spent way too much time reverse engineering how the average person actually pays for the lifestyle they're showing off. Because once you understand the math behind the illusion, the whole world starts looking different. The BMW in the lot, the designer bags, the charming $520,000 starter homes. None of it means what you think it means. This isn't a video about skipping your morning latte. This is about why our culture has convinced us that looking wealthy and being wealthy are the same thing, when in reality, they are often inversely correlated. Asterisk. Let's start with a number that I had to read 3 times to believe. Goldman Sachs published a survey in 2025 showing that 40% of Americans earning over $300,000 a year say they live paycheck to paycheck. Think about that. These are people pulling in triple what the median American family earns, yet they are one broken dishwasher away from a crisis. It makes 0 sense until you understand lifestyle creep. Every time these people got a raise, a bonus, or a promotion, they spent it. Luxuries became necessities. They bought the bigger house, leased the nicer car, and booked the Instagram-worthy vacation until the math on a $300,000 salary looked exactly as stressful as the math on a $60,000 salary. If you're standing in your office kitchen wondering how everyone affords their life, the answer is they don't. They just pay the rent on the illusion. Asterisk. The lifestyle you see is built on a scaffolding of creative debt. Layer 1 is credit cards. As of late 2025, Americans are sitting on $1.28 trillion in credit card debt, with the average interest rate hovering around 21.5%. Layer 2 is the stealth weapon. Buy now, pay later. BNPL. In 2025, 32% of BNPL users earning over $100,000 used it just to bridge the gap to their next paycheck. People are financing Coachella tickets and grocery runs because their wealthy lifestyle has no margin. Layer 3 is the auto loan. 1 in 5 new car buyers is signing up for payments of $1,000 or more per month. Greg doesn't own that BMW. He's renting it from BMW Financial. And here's the kicker, your coworker won't tell you. A huge chunk of them are getting subsidized by their parents. In 2025, 50% of parents with adult children were sending them an average of $1,474 per month. You're running a marathon. Brenda from accounting got dropped off at mile 22 in an Uber. Asterisk. But the biggest drain on your bank account, the thing that's officially making you poor in 2026, is the American dream of homeownership. Meet Lucas and Michelle. They just got pre-approved for $480,000. Their parents are texting, "Congratulations." But Michelle opens a calculator and realizes something terrifying. At a 6.3% mortgage rate, the median home in America now consumes 47.7% of the median household's income. We're currently living through the worst home price-to-income ratio in modern history. In the 90s, that ratio sat at 3.0. Today, it's 5.0. If you're making $80,000 a year, the median house costs you 5 full years of your entire pre-tax salary. And that's just the cover charge to get into the club. The house itself is actually the cheapest part of owning a house. Insurance is the quiet killer. Homeowners insurance has risen 46% since 2021. In Florida, The average premium is nearly $8,300 a year. Maintenance is a parallel economy. The old 1% rule for maintenance is dead. On a home built before 2010, you should expect to spend closer to 5% of the home's value every year on roofs, HVACs, and water heaters that have decided to stop working. The real estate industry spends $150 million a year on marketing to convince you that renting is throwing money away. But run the numbers. If Lucas and Michelle buy a $400,000 house, in the first month, $1,680 of their payment goes to interest, and only $299 goes to the loan. They aren't building equity, they're renting money from the bank. In 2026, the real flex isn't owning a ZIP code in a buyer's market desert. It's having the liquidity and the bravery to say, the math is broken and I'm not signing that waiver. So, if the rich lifestyle is a trap, what's the alternative? It's something called the snowball effect. But here's the part nobody warns you about. The beginning of wealth building doesn't feel like winning. It feels like financial torture. Imagine pushing a 2-ton slab of granite up a mountain. You've been saving $500 a month for 3 years, and your account says $19,000. You feel like a failure because your coworker's portfolio just jumped $47,000 in a quarter while he was on vacation. What you're experiencing isn't failure. It's physics. From zero to your first $100,000, you are doing 100% of the work. Your investment returns are mathematically useless. If you have $5,000 and the market goes up 10%, you made $500. That's just a nice dinner, not a life-changing event. But once you cross that $100,000 threshold, the equation shifts. Suddenly, a 10% year gives you $10,000. That's a used car appearing in your account, just because the market had a good quarter. By the time you hit $500,000 or $600,000, the game fundamentally changes. Your portfolio might grow by more than your annual salary in a single year. That's the crossover point. That's when you realize your financial future is no longer tied to your ability to trade hours for dollars. Let's look at two guys, Marcus and Tyler. Marcus makes $85,000 a year and drives a $55,000 truck. He looks like he's figured it out. But his bank account has $400 in it, and he's terrified that a Thursday insurance payment will bounce before his Friday paycheck hits. Tyler makes the same $85,000, but drives a 2019 Camry. He lives in a fine apartment and buys store-brand groceries. Tyler has $187,000 sitting in an index fund. Marcus is performing financial success. Tyler is actually accumulating it. The gap between them is 2,390 AM. On if Tyler keeps that up for 30 years. That boring Camry Anthos. Boring Grotchery Sternto. 5.4 million. Marcus isn't just paying for a truck. He has a hostage situation. He cannot afford to lose his job. He cannot afford to take a risk. And he cannot afford to stop performing because the audience of co-workers who aren't even really watching much. Notice asterisk. The reason I'm telling you this is because the one-income life is becoming a massive risk in 2026. Having one paycheck is like having one set of car keys. It works until it doesn't, and then you're locked out of your own life. But you don't need to become a 23-year-old extrovert with a ring light to build a second stream of income. There is a layer of people in their 30s, 40s, and 50s running what we call faceless YouTube channels. They aren't famous, they aren't on Instagram, and they have no incentive to tell you what they're doing. They use AI tools to handle the writing, the voiceovers, and the editing. They identify topics people are searching for, assemble the videos, and deposit the checks. In fact, you're looking at an example of it right now. This isn't about getting rich quick. It's about building a digital asset that compounds while you sleep. It's about creating a system where the work line stays flat while the income line moves up. Here is the ugly truth about your bank account and your lifestyle. Real wealth in America looks almost boring. The largest study of actual American millionaires found that the top 5 careers weren't tech bro or influencer. They were engineer, accountant, teacher, management, and attorney. 79% received zero inheritance. 8 out of 10 invested in their workplace 401k. 94% lived on less than they made. They drove paid-off Toyotas and lived in modest homes. They weren't on Instagram performing wealth. They were in their backyards, actually enjoying it. If you take the average new car payment of $772 and invest it from age 25 to 65 instead, you end up with over $6 million. That is the exact dollar amount difference between the coworker leasing the BMW and the quiet coworker driving the 2019 Camry. One is showing off now. The other is going to own everything later. So, the next time Greg walks into the break room with a new watch, don't spiral. Don't open your banking app in a panic. Just smile, nod, and go quietly automate your investments. The goal isn't just a number in a bank account. The goal is a life where the number stops mattering because you've built something that generates freedom while you sleep. Stop performing for an audience that isn't watching. Stop signing waivers for houses the math says you can't afford. If the math doesn't work, don't buy. If the status doesn't serve you, don't pay for it. The person you envy today is going to be the one asking you how you did it in 15 years, and you can tell them it was simple. You stopped trying to look rich so you could actually become wealthy. Hit the like button if this helped you see the illusion a little more clearly. Subscribe if you want to stop the performance and start the snowball. I'm Zen, and I'll see you in the next one.